So my name is Will Hackman. I'm the president of McCourt Energy Environmental Policy Organization. You can see what we're all about up on the screen. But basically, we are seeking to engage students, academics, and practitioners on policy issues related to energy and the environment. We believe that energy and environmental concerns are among the most important challenges facing policymakers today. And so if you haven't already, like us on Facebook, follow us on Twitter, contribute to our blog. It's open to anybody.
Careful what you ask for.
Yeah, not open to trolls. So before we begin tonight's event, which is our final event of the semester, I wanted to take a quick moment to recognize everything that McCourt E&E has accomplished in just one semester of being a new student organization. So we developed our leadership team with 8 dedicated and fantastic students across the MPP and MIDP programs. And, I think we should give a quick round of applause to everybody who helped pull this event together. Thank you, guys. They're all dispersed among the audience. Thank you very much. We established our social media presence with nearly 100 likes on Facebook, 76 followers on Twitter, and a blog that anyone can contribute to. We've collaborated with other student organizations on campus and helped to promote their events, including moderating a panel discussion at this year's Sustainable Oceans Summit organized by the Georgetown Sustainable Oceans Alliance. We've held discussions on U.S. and international ocean conservation policy, on coastal resiliency and climate change adaptation. I've gotten involved with the GPPSA and McCourt School in multiple events, including the February Energy and Environmental Policy Alumni Panel. Hosted an environmental film night screening of a short film produced and directed by McCourt E&E's very own Amy Richards.
Hey.
And that's not even everything that we've accomplished. So next semester, we look forward to connecting with more students, academics, thought leaders, and policy practitioners. So stay connected with us and stay tuned for exciting additional new events and opportunities. So, and now, without further ado, tonight we are going to talk what's happening to the price of oil, policy and political ramifications of the volatile market. So I won't read that whole thing. I think you all know why you're here. But it's a very important topic to talk about right now. So I'm going to put the bios for each of our speakers on the screen as they're introducing themselves. But if I could just ask each of you to just tell a little bit about what you do in your fields or at Georgetown, why you're here tonight. We'll do a quick round of introductions and then we'll get into the presentations. We'll start with you, Rick.
Well, first of all, thank you very much for allowing me to be here tonight. I'm both humbled to be among one of the panelists here with 2 esteemed colleagues and experts in the field, and I'm appreciative of the fact that I get a chance to talk with you all. In my day job, I work for the U.S. State Department. I'm the Director of Policy Analysis and Public Diplomacy. You say that fast and have $1.50, it'll get you a cup of coffee over at Starbucks. But very simply, we manage the policy analysis for the department for energy-related matters. We also oversee the messaging, whether that's direct through traditional media, social media, or e-diplomacy, as well as outreach to industry, academia, special interest groups like this. Also, a couple other small things thrown into the day job include training for the department for energy-related competencies, as well as overseeing our energy international organizations and multilateral engagements, things like the IEA, the International Energy Agency, the IEF, the International Energy Forum, ARENA, EITI, ARENA being the International Renewables Energy, EITI being the Extractive Industries Transparency Initiative, or the G7 and G20 energy-related matters. So pretty diverse portfolio. I would say just by one other part of introduction, I've been blessed. I've got about 30 years of experience in the energy field, 20 of which was with an IOC, Exxon Mobil, I worked various assignments in the downstream and the upstream. So I've looked at all segments of the oil and gas business, both domestically and abroad. Served in Germany, Australia, and in the Middle East in Abu Dhabi. And so most of the three regions. Subsequently had my own company where I did consulting and commodity brokering prior to joining the U.S. State Department almost 5 years ago. So that's a bit of a thumbnail. I hope this is an informative talk for you all. Please, Michael.
Hi, I'm Michael Shelby, and I'm really glad to be here tonight with you, and I hope we can have some conversation, stimulating conversation as we go forward. I teach at Georgetown. I'm an adjunct professor, and I teach environmental and resource economics. Three of my students are here tonight, and I guess that's a good sign. But basically, I also work at the Environmental Protection Agency and US EPA. And I'm the chief economist of the Transportation and Climate Division, and what we are working on are the vehicle rules and the renewable fuel standard. They're all kind of pretty high profile kind of issues involving affecting energy demand and all influencing oil demand. So that's what I've been doing. I worked in energy markets for over 30 years on energy and environmental issues, and I've worked on cap and trade issues, and I've worked on the acid rain program. I was pretty involved in some of the work there initially at EPA.
Hi, I'm Paasha Mahdavi. I'm here at McCourt. I'm a professor and teaching energy policy and energy politics. I also want to say thanks to Will and to Layla and the rest of the team for putting this together. Happy to be here and curious to see what directions we go with the panel today or tonight. My research is mainly on national oil companies on the other side, not IOCs like Exxon, but the folks that they're working with, the national oil companies, state-owned enterprises. But today I'll be talking a little bit about some fresh research on global gasoline prices. So, why we talk about oil prices, okay, so how does that affect you, and most people? And one aspect of that is gasoline pricing. And so excited to see your reactions to some of this new stuff that we found. And I'm a newcomer here. It's my first year at McCourt, first year in DC. So also exciting to meet some folks I haven't met yet. But I also see some of my current and former students here, so that's a good sign too.
Great, thanks. So I think we'll do all the presentations first and hold questions to the end, if that works for you.
Sure.
Great.
All right, as we get started here, I want this to be something that's useful and beneficial to you all. And I'll start at kind of the 100,000 foot level. I'll try and dive into a few of the details, but if there are questions, please jot them down and we'll come back to them as we go forward. If I can have the next slide, please. The purpose or the content that I want to go through, I want to talk a little bit about the U.S. supply situation. Then I'll work on, hang on a second, one second, please. Then I'll go into the resilience of the U.S. Energy sector, and then what are the foreign policy implications. So if we can, the next slide. What we have had happen here domestically is profound. The world's changed, guys. I grew up in an era where OPEC countries produced and OECD countries consumed. But that dynamic has shifted immensely. In today's environment, you're actually seeing a lot of the energy production in terms of hydrocarbons coming out of non-OPEC countries. The other dynamic, and it affects the climate discussions, is that we're actually at a point in time now where non-OECD countries are consuming more energy than the developed countries. It's a juxtaposition of where things were. A couple of key and salient events have really affected that, and I want to talk about what's happened here in the U.S. During the last presidential election, you all may recall, there was a lot of debate around energy independence. That was the real theme. Well, the reality, folks, is that's a fallacy. We live, as you well know, in a globally interconnected economy. And nowhere more so can you see that than in the global oil markets. So folks, what happens in one part of the world has a direct and material, and I won't get into Paasha's area here, but has a direct and material impact on our consumers at home. And we really care about that. The second thing I would tell you is what we have seen, which was the shale revolution here in the U.S., had a significant and a material impact on global energy markets, particularly global oil markets, and has in part been responsible for what you're seeing in the reduction in oil prices today. The two charts I have up here, and I'm not going to go into a lot of detail, really tell that picture both from an oil and a natural gas perspective here domestically in the U.S. And the key takeaways here I want to leave you with is that while we've seen tremendous growth domestically in our oil production, the fact of the matter is we're still a net importer. We've gone from just a simple decade ago importing a little bit better than 60% of the oil that we consume here domestically to last year we had reduced that gap to 23%. Where did that come from? That came from this shale revolution I referred to. What is the shale revolution? Well, if you're not a geologist or you're not in the energy sphere, it may be a bit elusive. But very simply, when I was studying petroleum engineering in school, you basically had very simply the dinosaurs died, the molecules got baked and cooked, they migrated up, they were caught in traps, and basically the oil companies or the industry went and dropped a straw, drilled a well down in there, and produced the natural resources. Well, what has changed, and it really started here in the U.S., is that through technology, through innovation, access to capital, the information that we have here in terms of geospatial and our knowledge of the reservoir, the infrastructure that was there, and also, very candidly, mineral rights incentivized without exception, and an important part of that was also the high and sustained oil prices, incentivized entrepreneurs, mainly the smaller E&P, exploration and producing companies, to go out and look for innovative and new ways to produce oil. They've actually found a way to produce it from what we used to call the source rock. Now, this really changed the balance. The debate for many years, and it drove both our domestic and our international policy, was around peak oil, this scarce resource that one day we were going to consume it all, okay? And so if you think about energy scarcity driving domestically our policies and internationally our policies, that's where we were just a short handful of years ago, a time where many thought of it as a zero-sum game. Countries were basically battling, looking for ways to gain access to these precious resources. Where we are today, and again, I say 4 decades later, and I use the Arab oil embargoes as a point of reference because that was where the developed countries got together and decided to have strategic reserves to offset supply disruptions, and that really began a lot of what you've seen even play out today to a time where what we're seeing today is more cooperation in the energy sphere. And the next 2 charts, and by the way, the same story except it's even more true of natural gas, what I said of oil and production, and the next 2 slides show this as well. The fact of the matter is we've had a prolific growth in our production of both, and it actually started out as natural gas and grew with the oil production as well, and that's the trend lines. And what you can see is you look both at this slide, which is the tight oil production in the U.S., and the next slide, the U.S. is going to continue to be a key player globally and in the global markets. And think about last year, some of the changes that occurred. Just recently, we had our first exports of LNG, liquid natural gas. Last year at the end of the year, they lifted the oil ban, and we actually are able to export directly to international markets. I talk about this connective tissue, it's there. And what's happened here in the US, the other thing that's really interesting, we had moved to a point where the development cycles were long. They were decades long. And the amount of capital that was used for the development of those resources was very intense. With shale, your cycle, your development cycle, is much shorter. And it's more akin to a manufacturing process than it is actually the age-old oil developments or natural gas developments. Why is that important? Because as ample supply has gone onto the global markets, what you're seeing is some decisions about those frontier or the unconventional, whether it's the Arctic, the ultra-deep water like in the Gulf of Mexico, or some of the stranded natural assets, natural resources, are actually being pushed out because of this advent and what's happened here in the U.S. Please continue. So I want to talk about the resiliency of the U.S. sector and what's happened. And there are a couple of interesting points I'd like to make here. You know, the first, if we can go ahead to the next slide, is that it's really interesting, the volatility, the spikes, the ups and downs that we have seen in oil prices. And in fact, just even in the recent past here, I've got a couple months of data here, I've tracked what the market is grappling with is what happens and what are the signals that industry, developers, financiers use to actually make some of these investment decisions. Now, historically, I talk about going back, you know, you'd have someone from OPEC or maybe Minister Naimi from Saudi Arabia, you know, one of the largest contributors to the global oil markets, who would get up at an OPEC meeting and make an announcement. We're going to have a production freeze, or we're going to do a cut in production. And lo and behold, the market would respond accordingly. Today, that's not the case. Both producers and consumers, there's a lot of noise out there, are grappling with what are the market signals that give the indications of where prices should be. What you can see here, I've given 3 examples of 3 different events in the last couple months. The first goes back to OPEC and Russia talking about oil teamwork, just simply talking about it. The markets immediately had a 9% swing. The second example is when the Venezuelan oil minister reinforced support for coordination on production. Again, a 6% swing. Now, folks, what I should have done here was translate that to billions of dollars. Because the amount of oil that's traded, you know, you guys have studied economics, you understand how it works. The amount of oil that's traded internationally, this has huge ramifications and consequences. I'll come on to that as I talk about the foreign implications. But now the discussion, and by the way, I was just on the phone, I'm developing and putting together my team and assessment for the Secretary. He's going out to the region, Secretary of State Kerry, and on the 17th Sunday, there'll be a meeting again in Doha by OPEC and certain other producers to talk about yet another production freeze. And very candidly, everyone is looking for how do we find that balance? Because you've seen a shift, an economic shift as well, between producers and consumers. While here domestically, when gas prices have fallen from $4 to $2, there's been a windfall for consumers. And again, Paasha, I'm sure, can talk to the specifics of that. But internationally, there's been a similar effect, but an opposite effect for many of these producing countries that are reliant on the oil revenues for their national budgets. So I'll come on to that. So the first here is what's actually happening in the spikes in the volatility. This comes off of a period where we had sustained high oil prices, but relative stability. And think about it. We had Iran sanctions. We had many supply disruptions, but yet now we're in a low price environment and we're seeing greater volatility. The second slide here, which I want to just make reference of, this really talks to the speculative posturing on markets that's happening. I want to draw a distinction between the physical flow of molecules and the paper trades that exist, okay? So oil traders will in fact actually look at the forward curve. What are the expectations? What does the forecast look like? Do we expect there to be a continued oversupply or an undersupply? Based on that, they're able to hedge their bets. And what you're seeing is you're seeing also the influence of paper trading. And this just kind of illustrates that graphically. But I think the part here that you all probably want to hear a little more about is what are the international implications? So let's talk about that. If you could go to the next slide. And again, before I get into that, I have to talk about what's happening here at home. I get back to this interconnected nature of the markets. First, there's been a lot of banter out in the news. The fact of the matter is, and the question is, at these current oil prices, could our own domestic industry sustain itself? Well, there's a saying in industry, prices chase prices up and prices chase prices down. And what we're in is we're in a period of increased efficiency. We've got a time where we still haven't fully realized the full benefits and understanding of the type of developments that have occurred here domestically. And so if I was talking to you all, as a matter of fact, I was with Adam Szymanski, who is the EIA's administrator, which is our database and energy forecasting administration here. It's the Energy Information Administration. I was over in Riyadh, and he was giving a talk about a year ago. There's a producer-consumer forum that the Saudis put on every year in the IEF. And, at that time he said, right now U.S. shale production, and again, a year ago, guys, January, U.S. shale production, notionally 70, it's resilient in the $65 to $75 range. But that feels about right. And then prices kept dropping and dropping and dropping. And imagine, everyone's question is all this new production that the U.S. has brought on that has helped global markets, would it fall off? And, well, industry has found a way. Yes, there are some natural lower costs to labor and materials when the industry is more competitive, but also there are still efficiency gains, and we haven't quite reached the peak of that standard deviation yet. We're learning smarter, better ways to develop our resources. And so the good part is, yes, we're going through a low price environment, but the message I want you all to take away from that is our industry here domestically is more resilient than people realize. And the fact of the matter is, they've become accustomed to this new price environment. And by all indications, we expect to see prices at the type of lows you're seeing right now well into next year. And there are some fundamentals of global supply and demand that make us believe that. But the assets here are solid. We have proven we have a way to develop it. What's happening is just like any business cycle, so think back to your macroeconomics, think back to some of your courses, any business cycle, the first ones in pay a premium, and hopefully they're able to recoup that return. But once you get the competition, some of those less efficient businesses fall aside. That's what we're seeing. You've actually seen an unprecedented number of bankruptcies. You're going to see the next will be some consolidation. I predict that out of this is going to come a stronger domestic industry. Why, again, this is important? Because the debate today is, can the U.S. be the swing producer? Can the U.S. bring back its production and therefore help when the price cycle starts to swing back up? Help the global or international market sustain itself so we don't go through these great gyrations from super lows to super highs and in between. So that's, I could go into a little more detail here. Now let's move on to the international piece. 4 pieces. Interconnectivity, I've touched on, so I'll keep it brief. Geopolitical tensions, you guys want to hear about that? We'll talk about inefficiencies and then global energy architecture, and I'll wrap it up. The interconnectivity. I mentioned these, and I'll go through it again very quickly. But the LNG exports, the crude export restrictions being lifted, And again, our commitment in our policy to maintaining global as well as regional stability, energy security. This chart and the next both really get at that. You know, a decade ago we were looking at importing LNG here into the U.S. The simple fact that we're producing more natural gas today and that we're not actually importing that gas has made more available to global markets. And now, coupled with the fact that we are actually exporting LNG today. Cheniere had its first cargo that went to Brazil earlier this year. Really shows how we have helped transform global energy markets. This is natural gas. Again, this was the lead indicator for oil. Next slide, please. Again, what you see here in the takeaway from these pie charts, if you look at the share of LNG, it was fairly well distributed globally, with Qatar being the most significant supplier. In just a couple years, by 2025, that distribution is going to look very different, with the U.S., Australia, Qatar being among those major producers in a very short, transformative period of time. Amazing. Next slide, please. You look at, I showed you the price slides on oil. Same things have happened internationally in the natural gas markets. And if you look, Fukushima, when Japan made the decision to take 1/3 of their power generation, the nuclear generation, offline, you know what, folks? They had to make up for that somewhere. They couldn't let the lights go out in Tokyo. What did they do? They imported fuel oil, they imported liquid natural gas. The attack that occurred, the Yemen's attack, this gets to the heart of Al-Qaeda, this gets to the heart of ISIS, and some of the geopolitical risks that exist today. And finally, the Russian invasion of Crimea. These are all salient points. What we had seen is what was internationally 3 regional markets that were relatively balanced by a differential. That differential was the cost to move that natural gas from marketplace to marketplace. I'm talking liquefaction, shipping, and regasification, to a spread between those markets to what today has kind of come back into parity. Now, that's important because, again, natural gas is still priced and tied and indexed to oil in many parts of the world, and these are long-term contracts. Now, what we have seen on the oil piece, and this is an important slide, and why I put this in the deck, was the simple fact is we're in an oversupply situation today. In fact, I talk about that global supply demand. You know, we've got about 1 million to 1.5 million barrels of extra production. Where's it going? You know, they're not turning the tap off. Well, the first mediating factor is this price volume elasticity. The price usually helps affect that. And therefore, the marginal supplier, the most expensive, usually goes off the market. That hasn't been the case for a variety of geopolitical reasons. So what is happening is, if you looked at globally, the amount of oil that is in inventory, we're at almost historic highs. We're well and truly above the 5-year average, but we are at historic highs. This is important and an often overlooked subtlety, because even as demand grows, and even if we had a supply freeze, like an OPEC freeze on production, there has to be a natural growth, and then that growth has to exceed the supply, and you'll start burning off what's in storage to get it back to more realistic levels first. I would be remiss if I didn't talk about the geopolitical tensions. Again, we've seen a lot of very interesting things happen in the last few months. You saw Iran return its production and its volumes to the global markets with the P5+1 agreement and the lifting of the sanctions on Iran. Just a golly gee whiz fact is that Iran had 40 million barrels of oil in storage, 30 of which was basically loaded on ships, ready to go to market once the sanctions were lifted. think about any product. If you flood the market, folks, it's going to have a price impact. Secondly, you have instability, and we'll talk about these black swans. You have a certain level of tension in the Gulf region in the Middle East today with ISIL or Daesh, depending on how you term it. But the fact of the matter is, Iraq is still trying to grow its production and bring additional volumes online, and in fact actually grew its production and exports last year. Now, that combined with what we saw in the U.S. and other incremental growth created this oversupply situation. But fundamentally, we have historic highs and disruptions. And you've got other volatility. We could talk about Libya. We could talk about Venezuela, the Petrocaribe, and the policies there and how they're on the verge of bankruptcy and what that does not just to that country, but to the Caribbean region, who has been dependent on them. We could talk even about Saudi Arabia, and let's talk about Saudi Arabia. The fact of the matter is, historically, they have had their hand on the valve. I talked about Minister Naimi earlier being able to give an announcement, but they've been the swing producer, and historically, they've been able to ratchet up and ratchet back. But if I went back to one of those graphs I have earlier, what you would see is a very interesting picture if you looked at the 1980s. The last time the Saudis faced this type of situation was in the 80s, the late 80s. And they chose to reduce unilaterally their production. They had commitments from the rest of the OPEC members to do so. But it actually cost them market share that took them almost 2 decades to rebuild in the Asia Pacific. They have been very clear that they are not going to sacrifice that market share. And today, Saudi Arabia is producing over 10.5 million barrels of oil, okay? When the summer season was over last fall, when you typically saw them, when demand domestically dropped, they would usually reduce their exports and their production, which would have an implication. No, they maintain that. And, there's some posturing there. So we at the department are very concerned for the reasons I talked about earlier, this interconnected nature. We're very concerned about what happens in the world. We want to make sure the markets work efficiently and they're well supplied because of the ramifications for us at home. So we're always looking at where are these black swans, what will the next be? Next slide, please. Just a couple of other points and I'll wrap up. There is a little bit of a silver lining here. This gets to post-Paris COP21 and the INDCs and the global commitments that have been made by countries. The fact of the matter is that this low price environment also incentivizes many countries to deal with a fundamental problem of subsidies and inefficiency that they have in their economies. I lived in Abu Dhabi. You know how much I paid for my water? Nothing. Do you know how much I paid for electricity? About 4 cents a kilowatt hour. Okay? What does it cost here? 9 cents. And we've got some of the lowest natural gas prices in the world. Why do I mention that? If I went to the local station, if I were a local there to fill up my car, I was paying 25 to 40 cents a gallon for gas. Now, today, many of these countries are announcing, because of the impact of the lower price environment and the fact of the compression, that delta between these subsidized prices they have at home and the prices on the international markets, that compression has allowed them to take some actions that otherwise could have resulted in civil unrest and strife. And so that's part of the silver lining here. And it's an interesting time. Next slide, please. I put this final slide up because one of the challenges we have today, diplomatically and otherwise, is the fact that there is no singular overarching energy architecture that exists globally. There are these different organizations I touched on them. I touched on the IEA, the IEF, ARENA, the EITI. They all peripherally address these issues. There's the G7 and the G20. G20 this year chaired by China. G7 being chaired by the Japanese. And they all address parts and pieces of this. But fundamentally, we've seen such great changes in the global energy markets. Everyone's trying to sort this out. I'll use the example of China. China, and you guys have studied this, set up an alternate economic system and model, which they've been successful for their investment and their development. Kind of counter to the existing structure within the OECD and other developed countries. Similarly, they looked very closely on the energy front. Should they set up something different, or should they participate in some of the existing structures? I'll use the IEA as an example. The IEA becomes kind of the gold standard on that internationally a lot of countries point to for energy statistics. They gather the data, they do the forecasts of upcoming demand and consumption. Well, the IEA is going through a period of modernization, recognizing that fundamental fact that I talked about earlier, that the OECD, when it was created, the IEA, OECD countries consumed 80% of global energy. Today it's less than 50, just under, about 49%. Within the next 2 decades, it'll be down to about 30 or 35%. They become irrelevant. They become a dinosaur. They have to evolve and adapt to current market conditions and structures. And so part of what they're trying to do in the modernization is reach out to the BRICS, the Brazil, Russia's, the India, Indonesia's, China, South Africa, and in particular I'd flag China and India, because those have been the engines that have been driving the growth in demand in the last decade and will in the next decade or two. And so we have to adapt. As diplomats, we have to have venues like the G7. It used to be the G8, now it's the G7. Well, the G7 has addressed energy security, and in particular, what it did, the very first thing when it went from the G7 to from the G8 to the G7. By the way, that's when basically Russia invaded Crimea and Ukraine. They focused on energy security in Europe, and that was the directives. That was what those developed countries focused on. The G20, I think the G20 is going to be pivotal in the climate debate and in the implementation post-Paris, because those are the 20 largest economies that are driving the most significant carbon footprint today. They will lead by example. They will help to try to find the interconnectivity and the consistency between implementation. Folks, we could go a lot of directions. I took more than I probably should have. I apologize to both of you for that, but I wanted to give a bit of a frame.
Yeah, no, thank you. Really appreciate it. All right, let's go to Professor Mahdavi next.
Sure. Yeah. Well, thanks, Rick, for putting the framework on it. Like you said, I'm going to touch on some of those points in more detail, especially with regard to gasoline prices. So I'll get to this in a second. But I just wanted to start by reiterating the point you made about the Sunday meeting in Doha that's coming up. You know, whether or not there will be a freeze in output. And, I mean, what is so fascinating about it is just such a different world than it was before. Because, you know, look at how the markets are reacting. It's not as it used to be. And a big part of that is as Rick mentioned, you're going to have a few players that aren't cooperating. In particular, Iran is going to keep increasing production. Brazil going to keep increasing production. Possibly Libya and Iraq, we don't know what direction they're going. So it is a different world. And to see Russia playing along with Saudi Arabia as a key player in these negotiations or discussions on Sunday is very, very different than what we saw in the 70s. You know, the other thing I want to mention just about the supply and demand issue, and you touched on this, just to think about some specifics. I mean, The issue is certainly not just about the increasing supply and what's that done to the price, but also just the sluggish growth in consumption over the past year and potentially for the next year, year and a half. In particular in the BRICS, you know, the IMF just had a report out titled Subdued Demand, Diminished Prospects, talking about growth for the next year. You know, Russia, minus 1% growth. Russia's a big consumer. Brazil, minus 3.5%. There's GDP growth, right? So South Africa, positive, but only about 0.7% GDP growth. So you know, those key drivers, India, China will continue to increase, but you start to see that sluggishness, and it's going to persist for the next year and a half. I like that you have that graph up there because there will be a rebound towards 2017, but you know, who knows, right? These projections, they start to get a little less reliable a year out. So then I want to talk about gasoline prices, and I'm glad you opened the door for that discussion in particular. I'll talk about fossil fuel subsidy reform in a second. But this is just a series of graphs that I'm going to talk about from some new research we've done, collecting data on global gasoline prices at a sub-annual level. You know, the IEA, IMF, World Bank, etc., the team has tried to put these together, but by and large, the best data we had on gasoline prices was biannual, every 2 years put together by the German Statistics Bureau, GIZ. And what we've done is try to get something at the monthly level, and really for a lot of countries at the daily level. To be able to make statements about patterns, right, and trends in global gas prices. So this is all of our data in one plot, essentially just going back to 2001. We collected it from back to 1990. Each gray line is a country, right? A country's gasoline price in constant 2015 US dollars. This red line is one benchmark, right? It's a benchmark of gasoline price based on a Brent WTI blend of crude oils and then refined into gasoline. There are a number of stories that we could tell about this, but three things that really jump out at you is first the spread, right? Gas prices are very different around the world. Right? We have some countries that are extremely high prices. We know that, places like Singapore, places like Norway, now Turkey, and some places with basically flat prices. Right? These are the subsidizers. I'll get to them in a second. And by the way, the U.S. is pretty close to that red line. We have some of the lowest gasoline prices in the developed world. Right? And so that is, how do we justify that? How do we talk about that in the context of COP21 and now COP22 coming up? The other is that you've got these different sets of countries. You've got countries that by and large follow the benchmark prices fluctuations. That's typically what we're used to here, right? That as the supply cost shifts, that's basically passed on to the consumer, plus some tax that's assessed at different levels of government. But then you've got countries that either fully fix their prices, and then there's an in-between group that are called kind of, they really regulate prices so as to smooth that shock onto their consumers. It's a different pricing scheme that we see around the world. So if you go to the next slide, this is just the gasoline prices of the major oil exporters in the world. So removing all the other countries, and apologize that some of this is not as legible from some of the seats in the back, but what we see is that, you know, oil exporters, they follow two paths, right? We know, of course, we've got Norway and Denmark way at the top, but you've got a lot of oil exporters that don't subsidize the price of gasoline. And by and large are above the benchmark. Yemen, I'll talk about that in a second. Congo and many other sub-Saharan African countries that are big exporters don't subsidize as much, and in fact many of them tax higher prices than the United States, right? So that is quite a cause for concern. And then of course you've got the ones that we typically think about, right? UAE, Iran, Saudi Arabia, Libya, Venezuela, etc., that are well below the benchmark, very heavily subsidized, not only gasoline but pretty much everything else. That's starting to change, but towards the end I'll say why that may not be a good thing. So I don't know if that silver lining really is there, and I'll get back to why that's the case. So if we go to the next slide, this is now weighting the price. So this is just an average glimpse of what's going on. That's the global mean price. If you put everything together, here's the benchmark again. By and large, looks like the benchmark price. You know, again, prices follow what's going on at the supply level. And what you see initially is that, hey, look, by and large, the world is taxing gasoline, right? So that's not bad. We are actually, on the whole, putting some premium on this. But if you go to the next slide, if we weight that mean by consumption, the picture looks a lot less rosy, and in fact, much closer to the benchmark. So this is weighted by who's consuming, and a big part of this is, of course, the countries like China, like India, who are consuming more than they had, going back in the early 2000s, have much lower prices of gasoline than some of the higher developed advanced economies, mostly in Europe and in Northern Europe in particular. So the gap between these two things is a lot smaller when we think about who's actually consuming this product. So the next slide will show that in more detail. So this is kind of approximation of global subsidy/tax. Of course, the average is a tax, about 40 to 50 cents per liter. And you could see the global mean, aside from one dip, it was Katrina basically, where things didn't line up exactly with the benchmark. By and large, there's some stability, right? We see the taxes, it looks like they're increasing over the course of time. Of course, if we look at the consumption weighted, that's not the case, right? In fact, things aren't necessarily getting a lot worse, but they're not getting better, right? So how can we think about this commodity, again, in the framework of climate change and what we can do to mitigate climate change, as well as what this means for government revenue and, of course, those who subsidize. So the next two slides are going to show this grouping of countries. So this is now broken down into what we call variable price states and those who fix their price. And by fix their price, I mean countries that, by and large, the price of gasoline doesn't really change from month to month. Right? It doesn't even change daily, of course, or weekly. Some of these prices are fixed at a certain setting for about 1 or 2 months at a time. And of course, for some, it's fixed for years at a time, as in Venezuela. They only now recently finally increased their price, hadn't done so since the 1990s. But what's interesting is these two groups, and this is a little bit contrary to what the IMF has been talking about for a long time, which is that the problem is fixing prices. That the problem is countries need to stop regulating, stop over-fixing prices and let them float. What's interesting is that there are a group of countries, and shaded in black here, if you collapse everything down, that do fix their prices. They do smooth prices for the consumer that are above the benchmark. So they remain net taxers despite fixing their price. But who's really the problem child or the problem children are these guys down here. The fixed price subsidizers, look at their prices are basically flat, don't really pay attention to what's going on in the benchmark. Again, these are the countries we typically associate with subsidies and places that are big oil exporters. And indeed, all of these fixed price subsidiaries, there's about 22 countries, all are major oil exporters or were at some time. Right? So it includes Indonesia in that group. So the final slide I have up here is just a glimpse at things towards the end of the midpoint of the summer, the last point we collected data. We're going to keep updating this as we go along. This is a group of countries that were subsidizers, if you think about where they were back in November 2013, right before November 2012, well before the price of oil collapsed. All of these countries were below the benchmark. And here's their trajectory afterwards. And so this black line's the benchmark. What's interesting is that, by and large, things haven't really changed, despite the fact that the oil price is dropping. Now, in a few countries, things are changing, Yemen being one of them, and a couple have since announced that things are going to change. But it takes a long time for that to happen. And in particular, for countries that have just relied on these low prices for such a long time, they can gradually inch their way upwards, but they're still a lot at a price that's a lot lower than perhaps they should be, not only for concerns about climate change, but also for how much this is costing their governments. There are a few bright spots in here, Angola, Yemen, and of course now some of the Gulf states are talking about this as well. But the point here, the big issue, and to get back to the story that Rick had mentioned, which is, what this does cost to governments. When you think about fossil fuel subsidies and other subsidies, and what the low price environment has done. So it certainly has created an environment to get rid of subsidies. But the problem is that even if they do get rid of some of these subsidies, and of course let's take the case of Angola that did increase its price, and now it's about $1 a liter in terms of constant $15. What happens when the benchmark goes back up? Well, if we look at the past and we look at other times where we've seen a collapse and then going back up, of course, the oil price is seasonal. It has a seasonality component to it, it's just longer seasons. What's going to happen is they're not going to move. Right? They're going to, again, be considered subsidizers. Right? They're going to keep their price below the benchmark. And as things change, we're going to get back to that world of, oh, wait, we have a big subsidy. And of course, this pattern will keep repeating itself over time unless there is a meaningful and lasting reform. And so that comes into the story of really what this means for governments. In particular, it's not just the fact that they're subsidizing, but they rely on this commodity for sometimes 90% of their government revenue. So of course, in an era of low prices, they're getting hit on both ends, right? So we've seen this happen in Venezuela, right? This basic government is bankrupt, essentially. Maduro has not done a good job of handling it. Of course, they're trying to change this. They're trying to decrease their subsidy, but it's not going anywhere quickly. Iran has managed to increase the price of gasoline, but it was met with severe riots early on during Ahmadinejad's administration, so they scaled it back. Now they're going to try it again. They're getting up there, but still nowhere near as high as where it should be. So just to kind of conclude on this, what does this mean for climate change? What does this mean, getting back to this point of the COP21 meetings? How are we going to get to below 2 degrees Celsius? How are we going to get to that agreement? We had an interesting talk about a month ago on geoengineering. That's one option that we can go, or we can actually engineer the climate, because the reality is, if we're thinking about mitigation efforts, subsidies and tax reform is one of the easiest ways to do this, technologically speaking. Might be a little bit tricky politically, but it's not being done. And the world prices, even if you're not subsidizing, taxes remain low, and governments are just not taking the opportunity that exists right now of low oil prices to perhaps increase those taxes, or at the very least maintain them on an ad valorem level, and that's certainly not what we found. And why that's important, just to kind of conclude, one statistic that does matter, this one commodity and others like it that account for transportation, that's 14% of greenhouse gas emissions. So that's a big chunk. It's certainly not all of the pie, but that's a big chunk of the pie that we could, and like I said, this is an easy technical solution to decreasing consumption and in fact decreasing intensity of an economy, but so far we haven't seen anything, especially in the last 16 years. So I'll stop there and looking forward to the discussion we have afterwards.
Great, thanks, Professor Mahdavi.
So I'm going to talk a little bit about oil market trends. I'm not going to talk in as much detail as some of these gentlemen did, and then some of the ramifications of all of this. 2008, we had a financial crisis. We've had world economic growth, which has been fairly sluggish since then. And while we've had world economic growth, it's been sluggish. We've had sluggish oil demand, particularly in OECD countries. So that's contributed in part to this oversupply situation. I agree with both of the other gentlemen here that the oil shale revolution has really sort of been a big deal in terms of production. Domestic U.S. production increased by 44% from 2012 to 2015, while oil imports decreased 24%. So that's a big deal, and a sharp reduction in projected U.S. imports is expected to be 60% by 2020 if you use the EIA, and 58% by 2025. So that's been sort of the big tipping point here. That's kind of, demand and supply were roughly in balance with slow demand, and then the extra supply came into the market, and so it's been a very hard situation for the oil producers to deal with. I'll add that one thing that I think that is sort of being priced in the market now, or at least is motivating people, is this worldwide effort at developing electric vehicles, because you see them driving around in affluent parts of the Washington, like Bethesda and other places, but you don't really see them in my neighborhood. But you do see the EVs being driven around, and the Teslas now are being sold at $35,000. You get a $7,500 tax credit with that. So, you know, I don't think that the electric vehicles are really having much of an impact on demand like in the near term. But I think if you're an oil producer, the thing you obviously have to think about is that the learning curve for electric vehicles is sort of as you produce more and more, the costs go down. And the costs have fallen dramatically, much faster than I think most people have anticipated. And what that means is that, you know, if you want to get down to commercial EV production that's competitive with gasoline at the learning curve projection we're going, it could happen faster, but 2050 if you just project out the learning curve on this exponential curve. Let's just say that EVs become competitive with gasoline in 2050. Well, you have a 100-year stock of oil and you have a 50-year demand period. So, you know, if I were an oil producer, I'd be very concerned that I would have like 50 years worth of oil sitting around that I couldn't sell. I don't know if you guys agree with that. But, so I think the EVs are a pretty important development, although, you know, this big sort of race to develop the EV across all of the major auto manufacturers, and Nissan is emphasizing, you know, its whole development strategy around EVs in some sense. So I think that's a big part of sort of why you have this oil market transition going on. I wanted to mention that, you know, a puzzling feature of oil markets, and it seems to surprise not only consumers but also experts, is erratic ups and downs in prices. And most of the time when you look at a chart on oil prices, you'll see you get the nice smooth path, you know. But actually, as we've seen from some of the charts here, it's very herky-jerky, zigzaggy. And, you know, there's been some work done on this by economists. There's a paper by Suranovit, basically in 1993, and what he did was he basically sort of took the EIA model of basically oil demand and supply and kind of ran it out with different capacity constraints, and basically what he found was that if you're a monopolist, the way to maximize profits was to have a period of excess supply and low prices. And then you have these lumpy investments. It takes a long time to invest and generate energy, and you drive them out of business. And then once you drive them out of business, you have these short-run elasticities, so then you get a big spike in oil, and then you harvest all the profits in that time period. And then after you go a few years or a while with this big period of harvesting profits, then oil prices, you allow them to collapse again. You go through low oil prices as people have built up all of these technologies and infrastructure. Infrastructure and technology have what we call long legs, is the way they called it. He called it, and then basically you allow this price path to go on. World, in an energy journal paper, Why Do Prices Jump or Fall, in 2008, said much the same thing, and found that, you know, it was a demand function with the dynamic lags, with the lumpy investments that I talked about, kind of these big investments that are fixed costs. Once they're paid off, the marginal cost of producing is fairly small. So, you know, he found the same thing. The short-run price elasticities are near zero, so a substantial price increase can rake in enormous revenues. So there is kind of a logic associated with having price paths that are like very erratic. And it's not like something where everybody's kind of surprised. Consumers are always surprised because, you know, they take the price today and they project it out, which is presumably over the next 3 or 4 years if they're buying a car. I think it'll be about the same, so they're kind of myopic. But, you know, it's these large producers that seem to be surprised as well. And, you know, it's a combination of sharp, short-run demand and supply elasticities, lumpy investments, and then these swings in demand and supply that can result, that can all create this kind of erratic kind of price picture. So on consequences, I think I'll talk about 3: economic, environmental, and then I'm going to talk a little bit about energy security. I think the biggest sort of surprise of this recent oil shock, and I followed oil for a long time. As a matter of fact, when I was at University of Wisconsin-Madison as an undergraduate, I wrote my senior thesis on, basically, was entitled, let's see what the title was if I can even remember. It was basically OPEC behavior in an oil-constrained world. So that was 1984, so that's a long time I've been thinking about oil. And, basically, the biggest surprise, I think, of this whole oil market, oil shock this time was economic. Because the idea here is that with oil prices, you get a price, it's like a tax cut, right? Because oil prices go down and consumers see cheaper oil. And, at first people thought, well, you get this price cut and you get a tax cut and people start spending and there'll be an increase in consumer spending. Well, it didn't happen. Now people are saying, well, it'll happen in a year. What's been a year almost. And consumers are still kind of tight-fisted, but maybe they'll loosen their wallet, and now they have cheap energy and cheap gasoline. We know that oil demand is increasing as people are buying, driving more and things like that. But that's another event that could happen, and we're sort of in the period where we're watching that. But there's also this kind of interesting point of view, and I really don't know what the right answer is, so I'm just throwing it out there. There's an economist, Oberfeld, who's chief economist of the IMF, and he's argued that basically that we've had this period from 2008 onward, which has been a period of very, very sluggish demand across the global economy. We're trying to recover from the financial crisis. It's not like the Great Depression, but it still is something that was like sort of unexpected, and it was like a black swan event, and it kind of created this very sluggish period of economic growth that we're still trying to get out of and recover from. And so what he argued was that these low oil prices have basically created another deflationary event, which is the last thing the world needs, right? Because we want higher demand and more inflation, actually. And what we've got is deflationary events, but we're at almost zero interest rates, so interest rates can't fall. And so the result has been that you've had a sort of increase in real interest rates, which has been the worst thing you can have for a global recovery, right? And so what he was saying is that, we're just sort of bumping along at almost zero interest rates. Japan has zero interest rates. These other countries have zero interest rates. So, if we have a situation like that, it could be that these oil price effects were actually not, beneficial to the world economy, but were contractionary, which would be like standing everything on the head of what an economist like me has been taught over 30 years of looking at oil markets. I don't know whether that's true or not, but it's just an interesting idea, I thought. The other issue, which I work at the EPA, so obviously I work on environmental issues, and I'll just, I'm not going to spend a lot of time on this, but obviously oil is the second largest fossil fuel that produces carbon dioxide. So this oil price collapse is just bad for the environment in almost every way, except for potential for subsidy removal. But, you get like a situation here where oil demand will increase. That'll be bad for the environment. We also will have a situation where all of the new technologies that we're trying to put in with fuel economy regulations and all that, the payback period, see, the technologies cost more than the conventional technologies, but the fuel savings pay back. And usually you have to have a payback period of at least 2 or 3 or 4 years to basically justify that investment. And as oil prices fall, the fuel savings become less, and so the payback periods get larger. So it means the markets, the implementation of policies to improve fuel economy become more difficult because they become more, they affect more the car mix and things like that. And so, and it can potentially have more economic ramifications. So, that is also the case with the biofuels. Biofuels basically are, the gap between the cost of a biofuel becomes more expensive with low oil prices. And there's almost every type of technology that you can think of that would substitute for oil that potentially has greenhouse gas benefits is going to be slower to penetrate into the market. So you have rising demand now because of oil. You have oil price collapse. You have less, sympathy for the new technologies to come in the market, which means that it makes it harder to hit these climate targets. And of course, as we know, climate is, going to go up. Temperature is going to go up globally 3 degrees Celsius in the next century. and that's going to have a tremendous impact on world's global civilization. We know that sea level is going to rise. We know that the coastal areas and where many of the world's major cities are going to be inundated. This is going to be a transformational event that will affect you in your lifetimes and will affect your children's lifetimes significantly. So all of that is going to be more difficult to achieve with these lower oil prices. That means, that's not a good story. And then for energy security, basically it's kind of a good news story in some sense. The way that we think of energy security is we look at sort of the monopsony benefits that we can get from a policy, and then we look at the macro disruption, avoided macro disruption sort of benefits we get from avoiding a price spike. And I think that generally speaking, the monopsony benefit from a particular policy like improving fuel economy or something has gone down, right? Because oil isn't as strategic in the economy anymore, right? It's less of a share, less of a dominant factor in the economy. But it still is pretty important, and it's something that people might not think about. Which is that while import costs have declined, total oil expenditures remain near historic highs, and in post-2015 oil expenditures are projected by the AEO 2015, which is our U.S. projections we use, remain double or triple the inflation-adjusted levels experienced by the U.S. from 1986 to 2002. So we still have value shares, which is taking price and quantity of oil and dividing by the GDP of the economy, is still fairly high. And so what we have is a situation where we're importing less, prices are lower, so the monopsony premium has gone down. And then we have the macro disruption effect. And there we don't see too much of a change because OPEC used to be 40% of world oil market trends. It's gone down with the new forecast to 37%, but then it's back up to 40. So OPEC is still basically, has a significant share of oil market production. So we're not seeing that change. We don't know if the macro sensitivity to oil shocks is changing. That's sort of an area of active research, and there's actually going to be a workshop on that coming up next year that will be sort of focusing in on that topic. And then we don't know also whether the oil disruption probabilities have changed. And so there's work at Stanford University on the Energy Modeling Forum there where they've had a recent workshop where they're updating the oil disruption probabilities for various regions of the world and trying to figure out how likely are they to have a shock. And I actually haven't seen that work because I haven't been too involved in that, and it's still sort of in preliminary stage. But we're looking to see what's going to happen with that effort, and that will help inform some of the political kind of things we're thinking about. So, just to quote Fatih Birol, who's executive director of the International Agency, he warned on energy security that the prolonged lower oil prices could trigger energy security concerns by increasing the reliance on a small number of low-cost producers, or risk a sharp rebound in price if investment falls short, as it seems to be doing right now. And then the other thing he worries about is the fact that Saudi Arabia could run out of assets to pay for the goods that they need. And if Saudi Arabia would have run out of assets, it's one thing for Venezuela to run out of its assets. That isn't really that big of a world event. It could cause, basically migration to the United States or other local impacts around this region. But if Saudi Arabia were to basically run out of assets to pay for their economic development, then that could have a very big impact on global trends. And he worries about that because Saudi Arabia is now running a very, very huge budget deficit, and I think they can go 5 years, 3 to 5 years, maybe 7 years before they just completely deplete their funds that they've saved up over the days and their trust funds to pay back with all these revenues that they've got. So, economic, not good. Environmental, not good. Energy security, kind of a wash. So the whole thing is just kind of a big disaster in some way. It hasn't really helped too many people, and it's hurt a lot of people. So I think that 60 buck barrel oil or 80 buck barrel oil or higher would be much better than what we have now, but I don't see a real mechanism to get there. As we've seen, there's a lot of flooded conditions.
Great, thank you guys.
Michael, I'd like to ask a couple of questions of you, if you don't mind, if
No,
you
go-
indulge
yeah,
me
go ahead,
for a
sure.
second. Because one of the very things that you touched upon around the investment cycle and the timing and the concern of the price spike and, you know, potential strategy by some producers, you're absolutely right. Economically, you know, it may be painful now, but the windfall comes, is the game changer of shale. And this gets to the workshop you were talking about next year. Arguably, development times were increasing, and I'll give you an example. In Saudi Arabia, the industry expectation is that they can produce at capacity between 12 and 12.5 million barrels a day. The increment to take them up to 15 million barrels a day is $100 billion, and these are their estimates that were out there publicly, and a period of 5 to 10 years. Okay, I say that because shale developments are very different than that. It's a different investment profile. The profile for traditional oil developments is a huge slug, capital intensive upfront, then this long tail, plateau and tail of production. Shale is more akin to a manufacturing process. You basically have to incrementally make your investments almost on an annual basis to keep the production going. And so the question that I think the markets are really grappling with, and I'd love your thoughts on this, is whether or not that shale production can kind of fill this void. Can it come on soon enough? Are there enough signals to make it happen? And can it help smooth that gap and therefore create either stability at a low, a middle, or some sustained prices?
Yeah, I think that, you know, that's a great question. I mean, that's the question that people are talking about is, you know, if the shale can ramp up and down and adjust to market conditions, it doesn't have long legs is what we're talking about.
Right,
This has been a big
exactly.
issue for like 20, 30 years in the energy literature, is long legs. And the idea here is if it can calibrate demand and supply much better, then you wouldn't get as much price spikes, and
Yep.
then it would become the swing producer. And so, like, let's say prices started to rise, then shale would just ramp up, and then if prices fell, shale would fall. And so it's as you mentioned, more like a manufacturing production process where you sit on top of a rock and basically mine it.
Yep.
And as you have a mining operation, it really works much more like a calibrated sort of technology to the demand conditions. So that is a question that people are asking. I don't think we know the answer because there's a lot of things that can affect price spikes besides just shale. And you know, the question is how large of an, if it's the marginal supplier, you know, there might be other swings, other marginal suppliers that might have, you know, very inelastic demand and supply curves too, or supply curves too.
Just one more nuance on the shale, and I'd love your thoughts on this as well. Different than the historic production pattern in the U.S., which has been kind of Gulf Coast oriented or Alaskan oriented, shale has been geographically diverse in the U.S., whether you're talking Monterey, Marcellus, Utica, Eagle Ford, Bakken. I've just named 5 regions and covered a fairly diverse part of the U.S. It's interesting. Can part of the economic impact we're seeing is this tied to this manufacturing, how quickly things ramp up, ramp down, and then the effects. You know, I lived through in the industry several cycles in Houston. We used to call it the boom bust. And you know, if you drive around Houston, you can see each of those eras in literally the way the city's developed. But now, rather than being kind of confined to one region and having acute impacts there, but being buffered through the rest of our economy, it's now being felt in geographically more widespread regions of the U.S. And I go back to a McKinsey study and IHS CIRA study initially at the start of the shale industry, which forecast jobs and growth and direct implications. Arguably, the shale revolution helped pull us out of the economic recession we were in. But the thing that I look at from those reports are the roll-on, the second order impacts. And I'm asking myself if, and you know, if academia maybe has a thought on this as well, has that been looked at as a second order impact and the geographic diversity of those changes, which is fundamentally different than the cycles we've seen in the past. Not saying that folks might not psychologically be saving the money because they got used to the higher price environment and their personal expectation is prices are going back up. Maybe that's one explanation. But this, you know, I don't know if you've seen anything, and I'd ask you as well, Paasha.
Well, I think, you know, right now, the U.S. economy is kind of sort of a bit of a precarious position. We have very low interest rates. We're pumping a lot of money into the economy to keep it going. People are worried about that. We have wage growth that's starting to rise. We want to generate inflation, believe it or not. We have unemployment, which is falling, 5% a little less, but we've got this huge group of discouraged workers that aren't counted in the unemployed statistics, and if you look at and count those, our economy is still very, very weak. And so, you know, you've got these trends that are underlying that, and then what you have is on top of that, this contraction in the oil market, and we're now a much bigger producer, and so obviously, and we are more diverse in terms of where we're producing. Obviously, Wyoming and Bakken and all those areas are getting hammered. The Eagle Ford area is getting hammered, but I think that that's got low-cost shale, so it's not as hammered as much. There's more production being cut back in more parts of the country, and so that's contributing to this overall malaise. But the overall trend in the U.S. economy is towards 5% unemployment, and we seem to be getting stronger. And we have wage growth, which is sort of trending up at about 2% rate, which is fabulous for us because we want wages to grow, because when wages grow, we get inflation, and we start to get like sort of pull ourselves out of a situation where we have all this debt. We want to have the debt paid back with inflation in adjusted dollars. We want consumers to have wages so they can spend money. The little bit of problem we have right now is that the wages are increasing, prices are not increasing yet as fast, and so profits are starting to get squeezed a little bit. But I think it's more the fundamental macro trends that are more influencing how we're thinking about employment.
And I'll just add to that, I mean, you were talking about the boom bust that existed in Houston. Some of the very preliminary studies on places like the Bakken, you look at Williston, North Dakota, that do exhibit a very similar boom bust, like even in the context of shale. Of course, they experienced their own boom bust before, 20 years prior to that. So it is very similar in that sense, in terms of how low the price has gone now. You get a big shuffle in, now there's a big shuffle out, but the differences are, as you said, the annual investment needs to be there in a more stable environment. And so, you know, who knows, and not just shale, but any other measure of unconventionals that we're starting to see become a bigger player than they have in the past. So I think it's an open question, and it is a big debate.
Great. Let's open up to the audience. Yeah, go ahead.
I guess that's on the geopolitical side, with what Professor Shelby mentioned about Saudi Arabia.
And actually, it might be helpful to just say your name and you know, what part of the...
Drew Smith. I'm a first year MVP. So with Saudi Arabia potentially running out of, I guess, assets in 5 to 7 years, as you mentioned, what can the U.S. or are there any contingency plans from the U.S. to really support Saudi Arabia in the sense that they're such a key asset in keeping stability in the Middle East?
I'd like to take a first pass at that. So let's dissect that a little bit, okay? Right now, Saudi Arabia has approximately $600 billion in their sovereign wealth fund, okay? They ran a deficit last year of somewhere in the order of 95 billion. Don't hold me exactly to that number, but right around that rate. They're forecasting a budget deficit this year of slightly less, but around 90 or so billion dollars. So if you just take the sovereign wealth fund in and of itself, you get to the numbers, the kind of 6 years they can sustain this. Now you also have to add to that sovereign wealth fund, the fund that the Saudis have in their banks, which are government controlled, which is about another $300 billion. What is Saudi doing right now? They're taking some austerity measures. Okay, last year they actually took on some sovereign debt. And if you look, that was something through a bond issuance, something they had never really done. And so they're mitigating that way, so they're diversifying or their exposure or their risks to try and mitigate the risks, I should say. Secondly, now the latest announcement, if you followed the press, is they're trying to, there's a whole program around attracting direct foreign investment, but particularly in the sector, looking at privatizing Aramco, potentially an IPO. Now there's a host of issues where could the U.S. be insightful or helpful is around the transparency measures and other things that would need to be necessary to do that. The third area that they're doing is, like a lot of countries, or like we do, if one of our spouses or part of our income gets cut, we take austerity measures. A great example of that is the metro project that they have in the kingdom right now. They've actually pushed out the timelines and reduced the spending. So there's a number of measures. Is it a risk? Absolutely. I think there are other geopolitical issues at play. You won't get a direct and deliberate discussion of this, but the subtleties include. And it gets back to protecting market share and the lessons learned of the 80s. Are they going to let Iran come back online and take back some of the market share that they lost? Well, right now, the public statements and what's out there is the answer is no. Is it, oh, by the way, a added benefit that Russia's maybe suffering a little bit right now, or you've got potentially Venezuela kind of teetering or issues? There could be some views, and there's been a lot of speculation, different analysts and studies looking at those, that the Saudis see that as not necessarily a bad thing. So, this dynamic and what I was trying to grapple with, and I think each of us have kind of touched on in our own way, is there's been such a change in these global energy markets and the interconnectivity as such. Everyone, ourselves included, U.S. government, we're adjusting our policy both domestically and internationally. OPEC, look at the meeting that's coming up on Sunday. Look at other producing and consuming countries, how they're reacting to this. Everybody's trying to decide, is there a new norm? What does that look like, and what are the factors influencing it? And that's the real challenge today. So that's kind of where I got back to where I was talking about, is there some sort of overarching energy architecture, a venue, a place where you can have some of those discussions that exist in different piecemeal fashion today.
Great.
I just want to add to that. You mentioned it, but it is a huge shift that privatizing Saudi Aramco, which was once untouchable. I mean, this was a jewel in the crown of the entire economy, if not the family itself. And now to think about even selling a share, I mean, it's unprecedented.
Yep.
So it tells you a lot about what's going on right now in terms of the austerity. And on top of that, I mean, I'm a political scientist by training, and so you think about what the government has been doing aside from just simple austerity measures. It's giving a little bit more in terms of political concessions. Right? Look at the recent gender reforms. I mean, they're incremental by the standards of anybody else in the world, but that's quite large. I mean, letting women drive, letting women potentially take part in the political process, I mean, that is a big shift. So, I mean, it is quite drastic. And they, by themselves, are trying to get to a position where even if they have to take even more severe austerity measures, people aren't going to revolt. One thing to add on to that is that they're putting more money into generating wealth from the Hajj. Right, so they've been building that program for a long time to know what's going to happen. So tourism is certainly something that's trying to keep them afloat, but it has been remarkable what's changed in Mecca over the last 10, 15 years. It's kind of like almost a corporate it's like a Disneyland. I mean, in a sense, there are buildings everywhere. It really is become a tourist destination. And so they are relying more and more on that. And what does that mean going down the line? It's strange.
Hey, Layla.
I'm Layla, first year MBA student. I just have a question that because Professor Mahdavi mentioned in terms of mitigating climate change and subsidy removal, that's one technical solution. And we also mentioned it's absolutely right now it's a rational decision for political leaders to make. But why don't they do this? It's just because political stability. If you created this environment, it's hard to make people to be used to a higher oil price again. Is this the only reason?
That's a big part of it. It's very psychological. I mean, look, here in the United States, when was the last time we changed the gasoline tax, the federal gasoline tax in the United States? 1993. That's crazy. If here in the United States people aren't changing the federal gas tax, imagine how hard it is in a place that's not quite as democratic as here, where people are accustomed to having certain things given to them by the government. Right? So if you change the price of gasoline, even if it's affecting only a certain stratum of society, in some of these places it is only the kind of the higher end folks that do have cars, you see uproars. And in fact, in a few places that have tried this, there have been massive upheaval and unrest. Even years ago, I mean, Myanmar, the saffron revolution was sparked by an increase in gasoline prices and a reduction in the subsidy. Nigeria had huge protests, and of course they scaled back the subsidy. Bolivia, same thing. Jordan as well. So it is very challenging politically to do so. But in an environment of low oil prices, you can start to create some incremental changes, some slow, stepwise style reduction of subsidies. And it is what we see Iran doing. And they've been able to get over the hump of protest, and they've kind of set into motion some slower stepwise reforms. But I mean, it's a political cost. It's hard to do.
And to that point, the two key underlying issues with these sort of reforms become what is the social safety net, and two, what is the communication strategy. And that's been pointed out by study after study, including the IMF, who's done a lot of work around the subsidies and framing the subsidies. The reality is that it's like, and the best way I can describe it, it's like that period in time when you're trying to sell your house and buy a new house. You almost need a bridge loan to get there. So people out there are dependent on these subsidies, the ones who really need it. You take that away, well, the government can't just pull it away and go through a period where that safety net is not there for folks, but they almost have to do that because they don't have the budgetary means because of the incremental cost to bridge from what is existing to the new. And so there are some real challenges with implementation. Now, I'm encouraged by the fact that several organizations, including the G20, including APEC, have taken on some really good initiatives, peer reviews and other things. Also a commitment by countries, and we're working on this right now. Watch the G7 or the upcoming G20 communique. We're trying to get a date certain for the removal of fossil fuel subsidies. But the key here, and I know this sounds silly, is how do you define those subsidies? And getting a common agreement on what we spent over a year negotiating with China our peer review in the G20. That was just us going back, the two countries voluntarily under the G20 framework, going out and assessing each other and learning lessons from one another. It was voluntary, there were no obligations for implementation, but just getting the scope of that agreed between the countries. That's how difficult some of these discussions are, because underlying it is that soft underbelly of civil unrest. And there are countries that really, really struggle with that.
Dr. Shelby, would you like to add anything to that?
No.
Go ahead.
Dustin Hanson, MVP first year. I was curious, what do you guys think is going to happen just as far as the world geopolitically with these low oil prices? Will we start seeing more aggressive moves by oil producing countries to help protect what little edge or market power they still have with the flooded over squat?
It's tough. I mean, you think, so on the one hand, outright aggression is costly, right? And so they're already suffering from
Yeah, you need money.
fiscal instability. On the other, I mean, tensions have been boiling between Saudi Arabia and Iran for, I don't know, a long time, if you really want to get historical, 1,400 years. But, I mean, about hegemony over who is going to be the market share leader or lion, and as Rick pointed out, Saudi Arabia is, at the moment, we're strongly opposed to letting Iran make that move. If it gets too far, you might see some more outright, more like a Cold War scenario than an outright conflict. So you may see some more opportunity for that, but I don't foresee anything large scale in the sense of actual conflict over market share, other than some of these tactics that have been going on and have existed for some time.
I think that, we have very sluggish demand in the West. We have, Asia is now not demanding as much. So you've got this sluggish demand picture, and then you've got this supply picture you've got Saudi Arabia is pumping a lot right now. You have Iraq that could go up a big slug of oil. You have Iran that could come up quite a bit. They're not exporting. They were at 6 million barrels, 20 years ago. So you have this huge oversupply situation potentially that could result. And so you've got it's a situation where, you've got these animals feeding at a pond and there's a drought and the pond is getting smaller and everybody's kind of trying to figure out how they're going to, drink. And so there's going to be more stress on that population. I think that there's going to be the potential for more conflict. Whether that will actually result is anybody's guess, but everybody now is competing for a smaller share of this, or competing for a share of the demand, which is not growing very fast. And so there's a great deal of tension, I think, and I think proxy wars could be one of the easiest ways to kind of sort of generate. These days, I don't think you really send an army out, not typically, and sort of just conquer somebody. What you do is you kind of sort of take a group that you're fairly comfortable with that's in the other country and you start to, foment some sort of independence movement or something. And so you get these stresses that are started and sort of evolve and fracturing of countries. So you could see that kind of activity. You have, the Kurds obviously are very interested in their own homeland, and they control a lot of oil up in Iraq, and then they're also in Turkey, and so that creates a lot of sort of problems for Turkey, and then you have to have Turkey trying to align with, the West to fight, ISIL, and it gets complicated. I mean, I don't really understand the Middle East well enough, I don't think most of us do, to really understand how all this is going to play out, but it seems to me like there's going to be an increasing amount of stress in this region. I don't know if everybody agrees with that or no.
Well, I mean, and in fact, is what's happening right now.
Yeah,
the proxy wars
exactly.
that exist, or in fact, that's the Cold War that I was alluding to, is what is many people point, especially the Saudis. What's going on in Yemen is backed by the Iranians. Some unrest that comes from Bahrain among the Shia population there, potentially backed by the Iranians. And of course, ISIS and ISIL in Syria. And so there's a lot of that already going on. And as Michael was saying, you don't see any outright invasions. Saddam is gone, he's going to start invading Kuwait. But that's, in the world that we live in now, and that will likely continue and perhaps foster even further proxy wars. But again, in that framework, I don't see anything other.
I think it's instructive, as my colleagues have pointed out, to not only to understand those dynamics, but the multifaceted nature of these dynamics. And the question you're asking is the right question, and the thing that theologians as well as practitioners grapple with, which is what's the next black swan? What's that event that's going to have an implication? And there are a lot of gaming theorists that look at, well, if this, then what? And whether you want to call that a domino or other effect. What I can say is that, for decades, for centuries, for millennia. Energy has been either a tool of close cooperation or one of conflict. And as such, our diplomatic efforts are focused around how we can harvest that. And I come back to the thread, the global thread of the interconnected nature. And we've harped on the negative side of it because these kind of shocks have implications economically and so forth for our domestic economies. But there's also some really positive value in that, and if harnessed in interlinkages beyond just this one sector occur, and you know, the world's getting smaller and smaller, and you know, the advent of technology and the things that you know, that happen today and the way those communications occur, if we can find ways to harness that, and diplomatically that's part of our mission, to be a listening post abroad, to be a representative for U.S. interests, to be an advocate for our economy and our commercial interests. It's looking for what are some of those solutions that kind of sew and tie people to collective good or common outcomes and goals. Part of that comes to what I was talking about, building this architecture and getting people to agree to what are the societal norms or the behaviors that are acceptable within that architecture and what are not, and you know, how we manage that. It's not, you know, I wish I could say there's a single silver bullet there that you could point to that would be what solves our ills, but the reality is, you know, this is why these kind of discussions and these sort of debates are occurring.
So we're running a few minutes over here, but hopefully our panelists will stick around and answer a few more questions. But if I could ask just one quick question before we break here. So I've heard that the United States is now the world's largest oil producer by volume, which I think a lot of people don't know. I mean, we still hear the drill, baby drill, you know, times from a few years ago, you know, trying to expand U.S. oil production. But now that we are the largest oil producing country in the world and we've just lifted the export ban, you know, what does that mean for the U.S. and the place of global pricing? You know, are we competing now with OPEC? Are prices going to go up in the U.S.? Like what does it mean for the U.S. to be the world's largest oil producer?
I think factually, right now, there was an expectation that based on the growth we were seeing from our tight oil or shale production that could occur. It in fact did not. I think we hit peaks of around 9.5 million barrels a day. Saudi Arabia is at notionally 10.5 right now. We've actually dropped down this year. I think we're around 9.1 million barrels a day of oil production. So Saudi Arabia is still above us, and oh, by the way, Russia is pretty close. If you take total hydrocarbons, coal, natural gas, and oil together, yes, the U.S. would be the largest producer. So kind of set that as a frame. But the fact that remains, and I come back to that oil, and we talked about we were importing 60%, that gap dropped to 25%. We're still a net importer, and in fact, we are part of that global economy and interconnected. And so you have to look at it and think about it in that context. And the changes, the oil exports, we still have other inefficiencies in the marketplace, but the oil exports is just another way that interconnected and nature of the markets can and should work in, you know, similarly approving LNG exports. Now, I think said differently, and this is something we grapple with, is does the U.S. use this newfound energy abundance as a political tool? And both the President and the Secretary of State have made clear, and this was in the context of Russia's invasion of Crimea, that no one country should use energy as a weapon, especially when you're at a time in, you know, the elephant in the room is there's 1.3 or so, maybe 1.4 billion people without access to consistent forms of energy in the world. And, you know, that is it a diplomatic tool? Yes. Is it one that we can help enhance global energy security? The paradigm shift that I've seen from my little foxhole and vantage point is that going from a zero-sum gain mentality, one of energy scarcity driving. Fundamentally, we not only care about today how our friends and allies meet their energy needs, we care about how our adversaries meet them, how other countries go about this, because of that interconnected nature.
And I mean, it may change, you know. For example, in 20 or 30 years, you know, Michael alluded to electric vehicles. So if Elon Musk can really produce a Tesla 3 that's $30,000 or less, that's going to change a lot for the U.S. and maybe we will see a shift away from net imports. But for the time being, I mean, what is it? 19 million barrels a day that we consume, or something close to that. So it's still a long way from being a major exporter.
Great, thank you so much. Really appreciate it.
Can't believe you guys hung the whole time.
Thanks to our audience.